Welcome to session 8 of the Rebel Income Coaching Program. In this session, we're going to turn our focus to another important element of the income generation system used by Rebel Income. We're going to talk about covered calls. Covered calls are an excellent additional income generation source on assigned stocks, on top of the premiums that we can receive from put selling and from dividend distribution. Covered calls is a strategy that works no matter whether you need to generate income from your investments or if your primary objective is wealth building over time. Now, the name covered call is derived from the fact that first you have to buy at least 100 shares of a stock. With Rebel Income, those purchases typically come from assignments from put sales when the stock closes below the strike price that you sold at expiration. Once the stock is in your account, you can sell a call option against it, which covers your stock position with a potential liability. Remember, anytime you're an option seller, in this case, a call option seller, you have an obligation to sell the stock at the call option strike price if the option buyer decides to exercise your option. The income that is received from a covered call trade is credited to your account immediately after the call is sold. So it gives you immediate cash. That's one of the great things that I love about covered calls, just as with put sales, is because you have that immediate income source to rely on. Some traders will use this income to provide for living expenses, or others may use it as a reinvestment tool for additional investments in their account. In any event, covered calls are very much like renting a house that you own but don't live in. If you leave it empty, you still own it, but it isn't a given that the value of the house will increase. It's essentially an unused asset. Selling calls against the stock is like renting the house. It provides you immediate cash, immediate return you can use as you wish. Now, if your principal purpose is growth and wealth creation, wealth building over time, covered calls are still useful. They provide the ability to take in extra income beyond any appreciation you may have realized in the stock. This additional return included time and time again over time, not necessarily on the same stock, but when you can repeat applying covered calls on stocks that you own over and over again, have an exponential impact on the growth of your account. This element is a primary reason that my preferred approach to covered calls is to sell out of the money call options above the strike price I was assigned when the conditions are right to do so. That gives me the opportunity not only to generate immediate income based on the covered call, but also to set up a potential sale of the stock above the strike price that I bought the stock at. Covered calls also have the added benefit of providing downside protection by lowering your actual cost for buying the underlying stock. The income received is subtracted from your original purchase price. The more you repeat the process, the lower your actual cost or cost basis will be for calculating your total profits. Traders especially find covered calls to be a useful strategy because it is considered the most conservative option strategy available. It's the first type of options trade that is made available by brokers to new options traders. It represents the first level of options permissions. Any liability that you may have by selling the call is immediately filled by the stock that you already own. That closes the trade, closes the position in the stock, and removes any further obligation. Covered calls are generally considered to be neutral trades, meaning that they work well when a stock is neither bearish nor bullish, as well as in slightly bullish environments, since you do have to buy the stock. So ideally speaking, in most cases, covered calls work in flat to slightly upwards trends. Okay. Let's talk about getting called out and what that means. When you're thinking about it in terms of income generation, remember that selling a call option gives the option buyer, the person on the other side of the trade from the call that you sold, the right to buy the stock from you at the option's strike price. In the example we have here on the screen, if I sell one covered call with a $40 strike price on XYZ company, I may bring in $1 in immediate income. If my original purchase price in the stock was $35, then the immediate income or yield that I receive on that trade is 2.85%. So I just simply, to calculate that return, divide the $1 premium by my purchase price. It's very, very straightforward. Now, if the stock is above $40 at expiration, then I'm going to be called out. What that means is that the buyer of my call option, the person on the other side of the transaction, can exercise their right to buy the stock from me at $40. Now, that sounds okay in this case, because if I sell the stock at 40 and I bought it at 35, then I make $5 per share on the trade, but I'm going to sell 100 shares of that stock at $40. The great thing about doing this with a covered call is that besides the $500 that I bring in that capital appreciation, is I also have that $1 of covered call income. So instead of just $500 from between the difference of $40 and $35 from just buying the stock and holding it to that level, I actually can make $600, which is a total return of 17% on the trade. Now that's a fantastic result. It is not necessarily a given, however, that just because I sell a covered call or write a covered call trade, that I am going to get called out. Remember that the only reason that the buyer would do this is if the stock is above $40 at expiration. That way they can buy it at 40 and sell the stock at whatever the stock's current market price may be. It could be 41, 42, 45, 50, 100. Whatever that level is, they have the right to buy the stock from me at $40. That also means that if the stock is below that point, then my covered call is going to expire worthless. And depending on where the stock's price is in relation to my purchase price, I may have an opportunity to turn around and sell another covered call relatively quickly. This is where sometimes we have opportunities to sell multiple covered calls against the same stock on a fairly continual basis. And that simply gives us the opportunity to continue to generate income and to keep the capital that we have in that trade working for us, kind of paying ourselves a dividend on a continuous basis. The other thing that is worth noting here, I don't have it on the slide, but I did mention that the option buyer has the right to buy the stock from me in this example at $40, no matter where the stock's current price is. A functional reality of covered calls that you have to be willing to accept when you place these trades is that by selling a covered call, you put a cap on how much your total gain in the trade could actually be. Here's what I mean. Let me give me just a moment. I'll pull up a document so that I can pull this up on the screen and make this a little bit more visible and easy to see. So let's suppose that I bought XYZ at $35 per share. So that was the first thing I did. The second thing was I sold a covered call. A little bit later, the stock's appreciated. It's sitting up around 40. So sold a covered call. We'll say it's a $40 strike price covered call. And I bring in that $1 that I already mentioned. And we'll say that the trade covers about 30 days. Well, let's say that XYZ at expiration is at $60. So it has really picked up a lot of bullish momentum. And boy, when I bought that stock at 35, now it's sitting at 60. That really looks great. But here's the thing. I sold this covered call at $40. So the option buyer exercises the call option, which means that they bought the stock from me, XYZ, at $40. I am required to sell the stock at that price at expiration if I haven't bought this call option back prior to this point to close out that potential obligation. So they're going to buy the stock from me at 40, and then they can do whatever they want. There's a $20 difference between the price I'm selling the stock to them at and where the stock is at now. So they're doing great. They're in position to make a 50% gain on their money. What is my gain? My gain is the difference between $40 and 35, which is $5 per share, plus, and that's the capital appreciation, plus the $1 that I brought in from the covered call. So no matter how far the stock goes up, the maximum possible gain I'm going to see in this trade is $6 per share. If I sold one contract, then that means 100 shares, means my total gain is $600. Now, does that mean that covered calls are a way to limit profits on winning stocks? Sometimes. The caveat and the reason that that I'm still in favor of covered calls is because these situations, when they happen, are impossible to predict. They are you can think of these not necessarily as rare, but exceptions to the rule. The advantage that selling the covered call gives you, yes, it does put a cap on how much of a gain you could pick up if the stock really accelerates and moves much higher in price. However, what it does is it gives you that immediate income from the premium you've received by selling the covered call. And if the strike price that you're selling is above the price that you bought the stock at, then you're also able to still factor in some of that capital appreciation. So this is really about trying to think about whether or not that potential gain is simply good enough. In my experience as a trader in the market for going on 3 decades, it's become clear to me that successful investing is really more about thinking about what kind of a return on my money is good enough, rather than trying to think about the maximum possible money that I can make in any given situation, and trying to hit a home run on every single trade I make. So in terms of thinking about what is good enough, covered calls are extremely functional. I also like to work with these with very short-term timeframes, as we'll talk about in a bit, which means that in a lot of cases, even when I'm working with, when I'm taking an assignment from a put sale, I often have opportunities to sell a covered call and get taken out of that position within a month or 2 months. In other words, within relatively short-term timeframes. And so when you think about the ability to free up your capital, reinvest it back into the market, keep it working for you with the same idea again and again and again, you start to work with not only an increasing number of trades working in your favor, but also a compounding effect that you generally don't see by trying to hold on to a position for as long as possible. Okay. Now, another element here when it comes to covered calls, I've already alluded to it a little bit, is there's an element of downside protection to these, and this is another reason the covered calls are considered to be very conservative. Going back to our example, if I have bought this XYZ stock at $35. Selling a covered call and bringing in the $1 premium on the trade, at that $1 can actually be counted against my net cost. So instead of $35, my actual cost basis in the stock is $34. The reason this is useful is not only for accounting purposes, but also because it provides a little bit of a buffer between whatever the stock's current price may be when you sell the covered call and your purchase price. It starts to widen the distance between those prices, and so that expands your ability to let the stock work within the various kinds of trends that it is going to form. Sometimes that can put you in a position to leverage a building upward trend in your favor. In a downward trend, it gives you a way to lower that cost basis, minimize the size of the loss a little bit, and hopefully make it easier to manage the position while you wait for it to come back to your original purchase price. What if you aren't called out? Well then, again, if you don't get called out, you still hold on to your shares. The call option goes away. The premium that you received at the beginning of the trade, you still will get to keep that regardless of whether you get called out or you don't, but you still have your shares. So if the conditions are still right for it, you can wait and look immediately for another opportunity to sell more covered calls. Now, sometimes, I'm not saying that you're able to sell covered calls immediately, again and again and again, but in some cases, stocks that I have held for a year or more, I may be able to place 5 or 6 covered call trades in over that period of time. In other positions, other cases, I've only been able to sell a couple. So there isn't a guarantee that you're going to be able to do this. A lot of it just simply depends on how close to the stock, to the original purchase price, the stock continues to be, and how you want to leverage covered calls. My preference and the way that I approach covered calls with the Rebel Income system is to sell covered calls when the stock is at or above the price that I was assigned at. This heading that we have on this slide is one of the main reasons that I really appreciate the opportunity to work with covered calls. We put a big focus on dividend paying stocks with the Rebel income system. And so when we are assigned stocks from a put sale, we have an opportunity to enjoy those dividend distributions. As long as we're holding the stock across an ex dividend date. Sometimes that may happen 2, 3, 4 times over the course of a year. The nice thing with covered calls is that besides those dividend distribution, the income from these covered calls can be kind of considered a manual dividend. It's something that you can put out into the marketplace. You can offer that option at a price you're willing to accept, and more often than not, there will be a buyer that will be ready to take that trade. So again, in the example of XYZ, if I purchase the stock at 35, it's at $40 or in that neighborhood now. I have an opportunity to sell that stock, sell the call option against that stock at around that $40, and I get an opportunity to generate that immediate income that that I can kind of count as a regular dividend. It doesn't matter whether or not the stock is anywhere close to an actual scheduled dividend. This is still income that I get to count for me. This brings up a question: what is better? Should you sell a stock if the stock has moved in your favor and you are several dollars ahead of your purchase, above your purchase price? Is it better to sell the stock directly or get called out? This is largely a matter of personal preference. In the example that I've used, let me pull up my my drawing tool for a minute because I want to highlight a couple of things. In the example that I've used, if I just skip selling the dividend, or excuse me, selling the covered call, and I just simply sell the shares. I bought it at 35. It's around $40 now. I sell the stock at that price. That is my prerogative. I can do that if I prefer. Just a moment. Can sell the stock for the $40 that you see here. I get my $5 net gain on appreciation. And so if I have 100 shares, I make $500. My total return on this position then, 14.2%, depending on how long I've held the stock. That's a nice result. And selling the stock, taking that profit, immediately frees up my capital for me to decide what else I may want to do with it. If I sell the covered call, however, I add that additional $1 of income that we've talked about to the $5 of appreciation. And so I get an additional $600. My net return goes from 14.2% to 17% on the trade. So I make almost an additional 3% on the trade. Now think about this. If you can make an additional 3% return on every stock position that you own when you sell out of the stock, when you get rid of that position, if you can do that again and again and again over time, even if you're not using covered calls every week, every month, but you're using these as a means to get out of the stock at a price that you're happy with a net capital gain that you're comfortable with, this extra income, this extra 1.5 to 3% that you may be able to gain from the covered call adds that much more return over time. This is what I mean by creating a compounding effect in your long-term investing results. Okay, let's talk about some basic rules to consider around covered calls. These are the basic rules that I try to follow, and that you will see me write about in the Rebel Income blog, and highlight with the trades that I place and that I manage. Does not mean you have to follow exactly the same rules, but these, especially if these are trades that you're new to, these can give you a good way to get things started and to get familiar with how to use covered calls, and then to make adjustments according to your own personal preferences if you choose. All right, let's talk about trend direction. We're going to assume for a moment, taking a look at Wells Fargo. Let's assume for a moment that I used Wells Fargo for a covered call trade, and I was assigned the stock. Let's say that I sold the covered, I sold a put option on this stock at $42 while the stock was experiencing this sudden decline. Suppose that I did this despite the fact that bearish momentum was increasing, because I really, really like the company and I thought $42 represented a very, very good value. And so that was an opportunity that I wanted to take advantage of. So in any case, we'll say that I'm assigned my shares of Wells Fargo at $42. You can see that the stock afterwards followed a significant downward trend, and then it gradually began to rebound and eventually pick up some bullish momentum, which we've seen continue to build over the last couple of months. Now, at the point here at the end of the chart, we can see the stock is back here right around the $42 price that I was assigned at, perhaps a little bit above it. Under the best circumstances, trend direction for a good covered call trade is usually going to come when the stock is picking up some bullish momentum, as we see here in Wells Fargo, or sometimes if the stock is simply hovering within what we often call a consolidation range, meaning that it is mostly running sideways within a narrow band between highs and lows. Those are also cases where there are often very good opportunities on stocks that I own to place useful covered call trades. Now, I've just talked about the trend direction. I used the example of Wells Fargo to show you how that can work. That does mean that sometimes if you're assigned a stock that is dropping below the strike price that you've sold, and you're assigned that stock at that price, you may need to decide whether or not you're willing to wait for the stock to come back to that price. You may need to decide whether or not you're willing to be patient and hold the stock through as it continues to decline in price. Once the covered call opportunity presents itself, one of the elements that you need to begin to think about is how much time you want to sell. There is a very strong tendency with covered calls and many traders to want to bring in the largest possible premiums that they can. And so what you will notice is that when you're looking at option chains, you can always get larger premiums by selling more time compared to selling less. If the purpose, however, is to try to turn covered calls into a useful income generation method, a practical way to set up profitable potential uh, exit points on a relatively consistent basis, just as with put selling, the best rule of thumb that I can suggest is to keep your time to expiration short. Put time decay on your side by selling 1 month or less. As much as I can, if I can sell only a couple of weeks of time, I prefer to do that whenever I can. When it comes to choosing a strike price, a similar kind of temptation exists. You will notice larger premiums are available to by selling at the money, or excuse me, selling in the money covered calls. And that may be okay, especially if the stock has risen significantly above above the price you bought the stock at. But if it's relatively close, selling in the money may mean that if you're called out, you may actually sell the stock at a little bit lower price than what you bought it at. My preference, as much as I can, is to try to work with strike prices with covered calls that are above the price that uh, that I was assigned at, that I bought the stock at. So de depending on what your primary objective is, the general rule of thumb that I like to use, if my focus for that particular trade is to generate income, it's okay to sell an at the money call option. What that does is that sets up a potential exercise for the buyer that may be much closer to my actual purchase price. And in some cases, maybe at the price that I was originally assigned the stock at. And that's okay. That closes out the position at the same price I bought the stock at. I have the income from the put sale, from the covered call, from any dividends I may have received, etc. And so that generally still works out to a nice overall result if my primary purpose is income. The other advantage that gives me is immediate liquidity. It eliminates that position from my account. It puts the capital that was tied up by those shares back in my account and back in play for me to use for another put selling trade, maybe in the same stock, maybe in a different one, but it gives me some flexibility to decide what I want to do next. If your purpose is to build wealth as well as generate income, if you're trying to kind of do a little bit of both, then it may be even better to consider trying to sell 1, 2, possibly in some cases even 3 strike prices out of the money. If the premiums at those levels are high enough to make the covered call interesting, what selling further out of the money does is it sets up an opportunity, if the stock is building bullish momentum, to bring in a larger capital gain. And so you will generally sacrifice the immediate income from the covered call on the hope that your capital gain is going to be larger. Not again, there's not a recommendation here as to which approach is better than the other. It really depends on your own personal preference, what your general goals are. If you're not sure which approach you might want to use, if they both sound kind of interesting, it's also okay to experiment with them in your trades and see what approach you prefer, what you think generally works better for your preferences, and then go from there. Okay. This is an option chain for Wells Fargo so that I can demonstrate some of the things that I've just talked about. The stock, as we can see, is sitting just a little bit above $42, as shown on the screen here. Again, I was assigned the stock at $42, and I have 3 different call option chains listed. excuse me, all of which offer strike prices in the general neighborhood of the $42 $42 price I bought the stock at. I can consider each week on its own basis to decide what I might prefer to do. Again, there's not necessarily one approach here that is better than another, but I want to give you an idea of how to try to evaluate some of these. Remember, when we're talking about deciding what covered call to use, you need to think first about how much time you want to sell, and then you need to think about what strike price you want to work with. Let's zoom this in a little bit so you can see these prices a little bit more clearly. Okay, so we'll go ahead and disregard the chain here that has 1 day to expiration, but we do have some interesting things to consider between 8 days, a little over 1 week, and a little over 2 weeks. So we know that I bought the stock at $42. If I want to be conservative, if my primary objective is income, then selling the $42 strike price is at exactly the same price that I bought the stock at. Let's suppose that I bought the stock, however, a week or 2 weeks ago. So this is a new position, and I'm not entirely confident that the stock's current bullish momentum is going to continue. Maybe the idea of selling the $42 call sounds pretty attractive because it'll free up my capital, and I can bring in this 75-cent premium based on the bid price that we can see here for that covered call. If I want to do the math for this, just a moment. I can divide that 0.75 by 42, which is my purchase price, and that gives me about 1.8% immediate yield for holding on to this trade for 8 days. Now let's think about that for a moment. That means that if I could repeat this process, if that doesn't sound very attractive, think about being able to sell this, make a similar kind of a trade, bring in 1.8% roughly every week. Let's multiply that by 52 weeks, and you're almost doubling your money in those cases. This is why I do sometimes sell covered calls at the money, very near not only the stock's current price, but possibly right at the price that I was assigned at, especially if an attractive premium becomes available very, very quickly after I purchase the stock. Now, by comparison, if I want to factor in a little bit of appreciation potential, I can also work with the 42.50 call. This is the first out of the money covered call. It is offering a bid price right now of 51 cents. If I get called out, not only do I still have that 51 cents, but I'm also giving myself a 50-cent capital gain on the trade, which is also interesting. Now let's consider this on a couple of different bases. First of all, the income on the covered call is not going to be as high as the 42. Obviously, this is a lower bid price that I'm working at, but if I divide this by my 42, and that's about 1.24%, again, that covers about an 8-day period. If I multiply that if I try to annualize this, multiply it by 52 weeks, then I'm still able to bring in about 64% on an annualized basis. That means that if in 8 days the stock is still has not gone above 42.50 and I'm not called out, that's not a terrible result. I may be able to place the same trade again and bring in perhaps a similar kind of return, maybe a different one. But this gives me an opportunity to still work with an interesting level of income, as well as factoring a nice little capital gain. Now let's think about if I do get called out. I have the covered call income of 51 cents along with 50 cents of capital gain. So making my total gain in the trade $1.01. If I divide that again by my $42 purchase price, now I've increased my overall return on the trade to 2.4%, which is better than what I would be able to do at the $42 call by only being able to bring in that 75 cents. So that may also be attractive. Again, a lot of this depends on what your personal preference is, whether you want to focus on income and trying to free up your capital as soon as possible, or if you're willing to try to factor in a little bit of capital gain and you're okay with holding on to the shares for a longer period of time if you aren't called out. Neither of these are terrible results. These just give you some different elements to think about. All right. Let's take a look at the other expiration on this, because we can also consider going out instead of 1 week. We could also consider going out a little over 2 weeks. We can consider this 15-day set of call options. With the $42 call, again at the money, right at my original purchase price, I can bring in $1.07. Which is also interesting. This is $1.07 divided by 42. So a little over 2.5% by going out an extra week of time. This means I'm going to hold on to the trade. I'm going to hold on to my shares a little bit longer. That may increase the chances that I get called out, but it's also not a given. But if we think about this on the basis of, hang on, we'll remember this 2.54% number, 2 weeks to expiration. If I think about a calendar year, 365 days, divide by 15, that means I may be able to place 24 trades. So if I multiply my 24 trades by that 2.43%, that's still a 58% annualized return by going out a little bit further in time. That's not that's also very, very attractive. This is also why I like to say that there's not really one single right answer to how to do this. Now let's think about what we might be able to do at the 42.50. Bringing in 81 cents versus the 51 cents here with just 1 week to expiration. Again, on an annualized basis, maybe not as much, but still very attractive. I can bring in that 81 cents of immediate income, divide that by my $42 purchase price, that's 1.92%. If I multiply that by 24 trades, that's 46%, even if I am not called out. If the stock is below 42.50 at expiration in 2 weeks, and I'm still holding on to my shares. If I am called out, then I get to consider the 81 cents in premium I bring in, plus the 50 cents of capital gain. Now I have $1.31. I can divide that by 42. And now I have about 3.11% over that time period. If I multiply that by 24 trades, then on an annualized basis, that's about 75% on an annualized basis. Again, this is why the idea of putting a cap on my maximum possible total gain in any single one stock position is not something that I'm afraid of. This is why I am strongly in favor of using covered calls rather than trying to ride a stock's trend as long as I possibly can. Okay, let's talk about planning your exit for just a moment. I've already mentioned that you could get called out or not called out. If you are called out, there is actually nothing that you have to do. The process of being called out is entirely handled by your broker. They will sell the stock at the strike price that you sold and settle that trade and all of the money associated with it for you. You will pay a commission for that and whatever transaction fees may apply, but all of that is taken care of for you. If the stock is below the strike price that you sold, again, you don't have to do anything. The option will simply expire worthless. You will not be called out. You will hang on to the you'll hang on to the stock. You'll still own it at the original purchase price. And the example I just gave you, that was 42. And you can wait to see what else you may want to do. If the stock continues to hover in that same general price area, you may have an opportunity relatively soon to sell to make another covered call trade. The reality, however, of not getting called out is that sometimes you and this is the same as with working with put selling, is that sometimes the stock drops below the prices that you've been working with, and that creates a circumstance where you have to be able to decide what you're going to do with the stock. Consider again, I said earlier, I made the suggestion that I bought this stock. I was assigned it from a put sale at $42, right around in this area. From there, in a period of only a matter of a couple of weeks, the stock picked up a lot of bearish momentum and bottomed. It actually tested a bottom here down around 38. Actually temporarily hit about $35 per share. Seeing the stock $7 below this $42 purchase price is significant. That is a roughly 15% drop in a very, very short period of time. And that creates a situation where you have to be willing to think critically about what you're going to do. Remember, one of the things about put selling with the Rebel income system is that we use this as a gateway to stock ownership in stocks that we believe have a good and attractive value proposition and very strong fundamentals. That means that by and large, the intention is to ride out these, even sometimes these severe downward moves in price over time. The fact that these stocks pay dividends gives us a way to try to moderate some of that risk and make it a little bit easier to endure. But you do have to decide whether or not you're willing to do that. Some of the traders that we have in our group prefer to try to limit their losses by putting in a stop loss. If they are, for example, if they are assigned at 42 on this stock, they may put a stop loss 20% below their purchase price. So they may put in a stop loss somewhere around $35, $36. In this case, that would have kept them from being called out, and then they would have been able to watch the stock appreciate again here, have perhaps an opportunity to sell a covered call in this area, but then again, watch the stock go down. Again, this is a situation where you have to decide what you're going to do and how you're going to respond. As I mentioned, some people like to use this idea of a stop loss to try to limit limit extreme declines in stocks. Sometimes if a stock extends into a very long-term downward trend, you will see it retrace its price by 50% or more, and that can be very, very difficult to endure and to watch. And so if that is something that you don't want to have to deal with, then using a stop loss may be uh, may be appropriate. Again, there isn't a right or wrong answer here. My method with the Rebel income system has been to hold on to stocks as long as I believe their fundamental profile remains strong, as long as the value proposition suggests that the stock should be worth more than the price that I bought it at. And as long as that is the case, then I'll continue to hold it even through some of these extended and protracted drawdowns in price. As a result of that, it does mean that I've held on to some stocks for 1, 2 years, and in some cases more. But as a result of that kind of patience, I've been able to bring in those dividend payments that I mentioned. I've been able to find multiple opportunities along the way to make other income generating trades, for example, with covered calls. And as a result, the overall success numbers in the Rebel income system and in the trades that we've been placing over the last 10 years are very, very high. We have a success rate of in excess of 97%, meaning that we win far more often than we are forced to recognize a loss. Okay, that's covered calls. In the next session, session 9, we're going to start to talk about trade management. Talked about some of the different pieces and elements that make up the different kinds of income generating trades we like to work with. But understanding how to try to manage those trades is going to be a primary focus of our last couple of sessions. In the next one, we will talk about position sizing, thinking about how much money to allocate to any one given trade that you may make. This should be a principle that you apply no matter whether you're talking about put selling, buying a stock, or working with directional options. We'll talk about the value of keeping a trading journal so that you can track your results over time, evaluate those results, determine what went well, what didn't, how those complement your personal and relative strengths and weaknesses. We'll talk about order types, what kinds of trades you should try to focus on placing within a practical income generating system, and talk about other ways you can factor in downside protection in the trades that you make. Thanks for your time. Hope you found this useful. We'll talk again in session 9.